I'm Marella Fernandez. Thanks for joining us today for Market Call. Daniel Straus on the show. He's Managing Director at National Bank Financial and taking your questions today on ETFs. Here's how to reach us. Toll free, you can call 1-855-326-6266. You can also email your questions in marketcall@bnnbloomberg.ca. Daniel, thanks very much for coming in today. Let's talk about ETFs. I'm wondering what it's been like over the past 6 weeks or so during these turbulent times, whether people have been drawn more towards ETFs. What has the action been like?
Yeah, no. Thank you, Morel, for having me. These past 6 weeks, as Vladimir Lenin said, there are decades where nothing happens, and then there are weeks when decades happen. It's not often you'll hear Lenin quoted by a capital markets professional, but these past few weeks were definitely like that, between tariff announcements and then reversals and then sudden intraday shocks and moves in the stock market and in currencies as well. It's been an extremely volatile time, but our clients who come to our desk for ETF research have been calling us many times a day. We're getting emails from advisors at National Bank who are wondering what to do in this kind of environment. It's very, very cloudy and confusing. Yeah,
so like everybody else, a lot of phone calls, a lot of questions from clients, that kind of thing. I'm wondering if there is one sector-based ETF that you are looking at these days as safer for your clients, or are you going another way entirely?
Yeah, so it's interesting. What we're seeing the market on the whole do is not retrench entirely out of equities. We're seeing flows kind of split evenly almost between fixed income and equities. 2024 was an interesting year. It was bull markets all the way. It was a record year for ETF flows both in Canada and the US, $70 billion, driven primarily by demand for the Magnificent Seven, demand for the S&P 500. So I still think there is still that kind of lingering wish and desire for those growth stocks to continue driving as the engine of the economy. But we're starting to see branches of flows move into things like a low volatility equity, certain aspects of the fixed income yield curve, as well as buffers and other strategies for capital preservation.
So are there investors drawn to ETFs specifically because they feel like they're covered more widely? I'm just wondering what draws them to an ETF as opposed to the stock.
Sure. Yeah. So ETFs are highly efficient. They give you incredible diversified exposure, sometimes to thousands of stocks all at once. They have enormous liquidity. Market makers are always, in fact, continually throughout the day, standing ready to execute huge orders. So we see ETFs being the primary and favored vehicle for large institutions that want to turn billions of dollars on a dime. So that kind of efficiency, their incredibly low fees, their very tight spreads, benefits investors as a whole. Investors, young, old, small, or large, can kind of piggyback off of this kind of world-class institutional liquidity that has been built around the ETF ecosystem. And we're seeing anybody who wants to invest with rapidity, put freshly liberated cash to work. Let's say they've sold their stocks, they very often move immediately into an ETF so they can still obtain some form of market exposure.
Got it. Okay, we're going to take a break, line up some phone calls and some questions for you. Daniel Straus, Managing Director at National Bank Financial, taking your questions today on ETFs. We're back in a moment. Here's how to get hold of us. Welcome back. Daniel Straus here to take your questions on ETFs. We'll start with an email from Adrian. Adrian says, what is the recommendation about investing in ZWU, the ETF? Is it a good time to get in? Tell me about ZWU.
Sure. So this is part of BMO's, Bank of Montreal's ETF suite. BMO is one of the largest ETF providers in Canada, definitely ranking as well as one of the top in the world, owing to their business here. This is their covered call utilities ETF. So this holds Canadian utility stocks and then writes covered calls on about 50% of the portfolio. Of course, that covered call overlay, which is, these are derivatives, is actively managed, but the basket is just utilities. We find that investors who want exposure to utilities can use this ETF if they're kind of neutral about a range-bound view in the Canadian utilities market. But if you think there's some growth on the horizon, that there is some prospect for these ETFs or for the companies to do some capital appreciation, you would probably prefer ZUT. That's almost the same basket, but with no covered call overlay. overlay. It means that the yield will be a little bit lower. There's less complexity in the product, and you can participate in some growth. So we know for people who are trying to meet monthly yield targets, they use the covered call ETFs quite effectively. But if you prefer to see your money work for you over a very long time period, if there is a sell-off in the market, or let's say you're buying near the bottom, you won't participate in the snapback as much if you're using ZW. So that's the risk there.
Got it. Okay, let's go to the phone lines. We have on the line today Elliot from Hamilton, Ontario. Hi, Elliot. What's your question?
Good afternoon. Another analyst on BNN referenced an ETF that focuses on buybacks that actually outperformed the S&P by 10%. I was wondering if you have any Canadian-denominated or U.S.-denominated ETFs that focus on buybacks. Thank you.
What's the advantage of focusing on a buyback?
Sure. So buybacks are similar to dividends. They're just ways for corporate America or Canada or anywhere around the world to return money to shareholders. A buyback is when a company treasury just takes cash on hand from their operations and reduces their share count so that remaining shareholders see a little bit of a price increase, a little bit of accretion of the company ownership, and it kind of can insulate the share price of a company from dropping down. It's actually no different from a dividend theoretically. If you have cash on hand in your company and you're paying out dividends, there's a lot of finance theory that says the two should be precisely equal. The thing is, we live in the real world where there are things like taxation, and for most investors, they would much prefer to see capital appreciation rather than income ongoing. Now, I know we were just talking about investors who prefer income, so it's a bit of a confusing contradiction, and it's a very controversial subject because there are ways that buybacks can be used to kind of like insulate large stock options from vesting and diluting share count and causing price declines and stuff like that. So a whole academic literature on it. Thank you so much for the call. I thought that there was a buyback-specific ETF in Canada. There may be some, if you look for under the keyword for shareholder yield. I know that Invesco partnered with some index companies that were pioneers in trying to understand shareholder yield, not buybacks and not dividends, as the core concept, because shareholder yield combines dividends and buybacks as the true signal for how company management is returning money back to shareholders. So I'm afraid I don't have a ticker symbol at hand for the caller. I'm sorry, but if you look in the U.S., there are some ETFs that focus on shareholder yield. They incorporate buybacks. In Canada, I believe there was one, but it did delist because it's a bit on the outside or on the outskirts of most people's attention these days.
Got it. Okay, let's go back to the phone lines. We have on the line John from Markham, Ontario. Hi, John.
Hi, good afternoon. My call. I'm moving into retirement, and I'm trying to research for the last 6 months an ETF, a covered call ETF that maintains stock price neutrality. So this is a year.
Sorry, John, can you repeat that? We just lost you for a second.
Sorry. I'm going into retirement, and I've been doing research on trying to find a covered call ETF that maintains stock price neutrality. And most of the ETFs, covered call ETFs I'm looking at, they're giving you that 9 to 15%, but they're also going down the same amount. The stock price is going down the same amount, if not more. Therefore, you're really not gaining anything. Mm-hmm. Can you suggest an ETF that can maintain its stock price while giving you the yield, please?
Okay, thanks for the question. Let's talk about that.
So that's a really good question, and it strikes at the heart of how these covered call ETFs work. They hold the basket of stocks, and then they just write call options for a little bit of additional yield. So exactly as the caller has noticed, if the stocks fall in price or experience any kind of drawdown, you participate in that 100%. Now, the extra little bit of premium yield you're collecting along the way does buffer you a tiny bit, but you have full downside participation. So I think the caller is probably looking for a way to implement in an ETF something what we would call in derivatives trading a collar strategy, some kind of put protection that does offer some insurance against a downside fall. And there's a whole slew of new products called buffer ETFs that are kind of complicated because they only have 1 year time horizons, sometimes a little less. There are buffer ETFs from First Trust and BMO in Canada, as well as from Innovestor in the US. They use use covered calls and put protection to kind of neutralize that downside move. I would say, though, that because they're sophisticated and they have this kind of calendar roll effect, it may not be exactly what the caller is looking for. So I would encourage you to look at ETFs along the lines of purpose premium yield, for instance. This one implies both puts and calls as well to do some form of downside protection. It's not 100%, it's not always guaranteed, but they're using sometimes combinations of puts and calls to do some kind of protection. They're also writing puts, so it can be sophisticated and complicated. It's very actively managed, but in our analysis, these kinds of ETFs don't participate all the way in some of those sell-offs.
Got it. Okay, let's go back to the phone lines. Bill's on the line from Pickering, Ontario today. Hi, Bill.
Hello. Thank you for taking my call. My question is on JP Morgan U.S. Equity Premium ETF. JEPY is a symbol. I bought it on the Canadian side at 26.5. It dropped actually to $23 during the tariff discussion, and it's currently at 24.5. So it's made its way up from the lows. Would it be a good time to buy a little bit more right now? So it's off the lows, but it's on its way up. So it's still below my buy price. Your thoughts would be appreciated. Thank you.
Sure.
Thanks for the call.
Yeah. No, JEPY, as we call it affectionately on the desk, is one of the largest and most popular and fastest growing covered call ETFs, owing precisely to the fact that it's very, very actively managed, and the manager in the U.S. With JP Morgan is very transparent with how he's actively managing that portfolio, kind of moving strike prices and coverage and so on, so that you can participate in these kinds of recoveries. It's interesting, too, because it has amongst the lower fees in covered call ETFs, which is something we like to see. MER is very important. It's not the be-all, end-all, but JEPY, the one in Canada, for instance, has a stated fee of 35 basis points, and sometimes you'll see 70 or 100 basis point type fees in these kinds of products. So that is definitely a point in its favor. Yes. Yeah. So I would say that if you kind of think of this ETF as a stock that will have buy levels, entry points, and exit points, the fact that it is a covered call kind of like breaks that paradigm a little bit, because those calls, if there is a very rapid move in the market, they're going to get exercised, and you'll have only partial upside participation. So really think of this kind of ETF as a yield instrument. Look at its yield. The one in Canada, I would say, if we take a look at it real quickly, has an indicated yield of something like 8%, which is quite high. That comes from a combination of the dividends and the premium income that you get from writing those calls. That's the way you should use it. It's a tool for yield, not necessarily for market appreciation. For that, a plain vanilla index ETF, such as something for the S&P 500 like XSP from iShares or something like that. There's dozens of S&P 500 ETFs or total stock market ETFs. Those are the best ways to enter if there's been a sell-off and you're trying to recoup your investment.
Got it. Okay, we're going to take a quick break. Daniel Straus sticking around, Managing Director at National Bank Financial. He's taking all your questions today on ETFs. We're back in a moment. Welcome back to Market Call. Thanks again for joining us. Let's go right to the phone lines. Rob has been holding. He is on the line in Calgary. Hi, Rob.
Hi. Thanks for taking my call. I have a two-part question for Daniel on HMAX, the Hamilton's Canadian Financial ETF. Would you recommend this ETF for an investor looking for income, or do you think it would be a better strategy to split between a covered call from the straight covered call ETF and a non-covered call ETF in the same space, such as BMO's ZEB? Thanks again, and have a good afternoon.
Thanks for the call today. Go ahead.
Yeah, no, thank you. So HMAX definitely caught a lot of attention, particularly amongst self-directed investors who are sorting by yield when they're looking at ETFs in Canada, because it has amongst the highest yields we've ever seen. I think it's something like 14 or 15%,
wow. Okay.
Which is, when you see a yield in the double-digit range, especially that high, you should probably contemplate how are they doing that, where's it coming from? And, if you do need yield that high, there's very few instruments that will deliver it to you, but the way they do that is with very aggressive covered call writing. We've talked about that a lot. There are ways to be aggressive, and what I mean by that is how close are the strike prices to the actual trading prices of the stocks on the day the options are written. How much of the portfolio is being overwritten? Is it 25 or 50 or 100%? Those are all metrics that determine your outcome. And when the covered call overlay is particularly aggressive, you'll get a very high yield today, but you will get very little growth going forward. And that's the trade-off. It's almost a certainty. It's not a pure certainty because calls and options are probabilistic. But what it means is that, exactly as the caller suggested, if you blend this ETF with a non-covered call analog, what you are doing is you're kind of tuning that aggression to what you feel you need in your portfolio, and it's kind of a clever way to do it. If you were to pick an ETF that had less covered call option overwriting, let's say 50%, such as BMO's ZWB on the banks, then you're kind of stuck with what the manager has determined is the optimal way to kind of write those options on the portfolio. So HMAX, very, very high yield. I would say that the best way to use it is in concert or in parallel with other forms of investments that will participate in a market rise, like ZEPY, which is just the Canadian banks and no options.
What percentage would be considered aggressive? Anything above 50%?
Sure. Yeah, definitely. Anything above 50%. You know, there are some from the likes of CI that have something like 30% covered call overwriting. That gives you less, that gives you like 2/3 participation in the upside at the worst case scenario, you know, if there's a very, very rapid bull run. What you find is if you compare these ETFs on a total return basis over very long time periods with non-covered call alternatives, they almost always underperform from a total return perspective. You can't beat their yields, and so that's definitely why they're very attractive to a lot of investors and why a lot of people use them, especially if they have, you know, cash flow targets. Very handy tools, but they're a little bit more expensive, and they do sacrifice part of the purpose you would be investing in equities in the first place, which is growth.
Got it. Okay, let's get back to the phone lines. Margaret's on the line today from Victoria. Hi, Margaret.
Good morning.
Hello.
Go ahead with your question.
Okay, my question is the difference between VI and VIU. Is it a good time to buy, and would one be better in a registered account or a cash account?
Okay, thanks for that question.
So this is a good question. VI and VIU are both very, very similar, you know? And I would say that the question of what kind of account to hold an investment that holds international developed equities depends very much on a whole bunch of things, whether the ETF is a wrap of a U.S. listed product, whether it holds international securities directly. We actually wrote a whole report on it. We wrote a whole report which was a practical introduction to foreign withholding taxes. So tax is a very, very complicated subject, and I would urge the caller to consult your tax advisor to ask about how withholding taxes might be foregone if you hold an ETF like this in an RRSP. So withholding taxes are levied by governments when distributions cross border from one jurisdiction to another. Their withholding taxes rate will be about 15% of the yield.
Okay.
It'll be levied when these companies pay their distributions, let's say, into a U.S. ETF, and then when that U.S. ETF pays the remaining 85% distributions into Canadian ETFs, there could be another layer of withholding tax. I'm not saying that's what's happening in this ETF. In fact, I do believe that the Vanguard ETFs, with a few exceptions, those that are listed in Canada, hold their underlying stocks directly. But, this one is ex-North America, which is something you want to see as well. You don't want it to be, for instance, ex-US. There are some from Vanguard that are ex-US, which means they hold a little Canada in them. So those are particularly inefficient because you will be wrapping a US-listed ETF that holds Canadian stocks, and the withholding tax will be levied as the Canadian distributions go into the US and then again when they come back. There are all sorts of I want to say, archaeological remnants of the way the ETF industry used to be constructed. These products were never kind of retooled. Just parallel ETFs were listed alongside them, and the VIU is one of them. So I would say that the main difference between these two is, there's almost no difference, in fact. But VIU is definitely larger. It's more liquid. Their fees are very, very low. If you want international equities, and we've been speaking with a lot of investors who do want international equities because they want to kind of sidestep the Canada-U.S. component of the trade war. It's perfectly valid to do. But there's others that are, for instance, just large cap if you need a little bit of security. So ZEA would be one of those. That one's also, there are some with also currency hedges as well. XEF is one of those. So, there's many, many different ways to approach this, and I would say there are some reports that you could read to help you tease apart the differences.
That's very, very complicated, as you mentioned, try and figure that out. Okay, let's try and get to Dave before we have to take a break. Dave's calling in from Calgary. Hi, Dave.
Yes, Yes, hello. I'm looking for an ETF suggestion for cash. And I talked to one of the consultants a couple of weeks ago. He didn't do ETFs, but all he said find an ETF that's a money market or a high interest savings account. I'm wondering if Daniel could suggest an ETF in one or both of those.
Okay.
Yeah, absolutely. So this is an area in which the Canadian ETF market in particular has shone to really kind of deliver some innovation for investors, just like our caller, Dave, thank you, who is looking for a money market ETF. The purpose kind of upset the apple cart here by launching PSA, I want to say in 2013. This ETF was the first amongst its kinds, and it just took high interest savings account, stuck it in an ETF, passed the yield on to investors. It was higher even than bonds and commercial paper at the time, but there has been some regulatory changes. The banks can't quite pass on those kinds of retail level yields into an ETF structure anymore. There's been rate hikes, there have been rate cuts, and after the dust has settled, there's a whole bunch of money market ETFs that now pay even slightly higher yields than these cash alternative ETFs. One would be, for instance, ZMMK from BMO, ZMMK, and another one would be a relatively new CMNY. We might talk about it a little bit later on the show. That one's from CI. But there's a whole bunch as well from, there's one from 9Point, NSAV, which holds not just money market, but other kinds of commercial paper and corporate debt. So there are ways now within the ETF industry to kind of get exposure to money market, but maybe even blend it in with other instruments and get a little bit of extra yield. It's a little bit riskier than cash. And these kinds of ETFs, these tickers, all have funny stock charts because they have very, very stable NAVs that kind of tick up every single day as the ETF managers accumulate their cash positions, which are then paid out monthly. So unlike a cash account that's not accruing every day, you will get a monthly distribution, which net at the end of the year can have significantly higher yield than you might be getting in your checking or savings account. So definitely check out the tickers I mentioned. You may find that you will get a little bit of a yield pickup on your cash if you use these kinds of ETFs instead.
Got it. Okay, we are going to take another break. When we come back, we'll have a look at Daniel's past picks. We're back in a moment. Welcome back. Daniel Straus is with us today. We're going to take a look at his past picks from April 5th of last year, so April 5th, 2024. Dynamic Active Preferred Shares ETF was what he chose. It was $21.23 at the time, and now down to $23.19. So an upside here, is that correct on, yes, 23.19, upside of 9%, 15% total return, and a good yield on this one.
Yeah, so investors love preferred shares in Canada because they have like a fixed income-like distribution, but they have what's called Canadian eligible dividend tax treatment. So it's a very nice tax-efficient way to get a fairly high yield, especially if you're in a higher tax bracket or even one of the medium tax brackets. It's something that you could mix into a fixed income portfolio so you're not paying your top marginal tax rate. However, it isn't the same thing as a bond, absolutely. These have shown enormously high volatility in the past. They can come under liquidity pressure. The whole pref market itself has been actually kind of shrinking and kind of getting all sorts of different kind of liquidity issues there. But this ETF is actively managed by the team at Dynamic, and they've done an incredible job at outperforming the passive benchmark, for instance, in this space. There is an S&P TSX active pref index ETF. This one's outperformed and delivered a little bit of upside. I would just caution investors that these can draw down by significant double-digit percentage, even more if there is a sell-off.
Okay, so you've got to have the stomach for it.
You do. So small position sizes, I would say.
Got it. Okay, let's go to your next past pick from last year. A Global X Enhanced All Equity Asset Allocation ETF. 2388 recommended, 2652, so an 11% upside return and a 13% total return. What do you like about Global X?
So I like this ETF because, there's a whole suite of ETFs that have been very popular called the multi-asset or balanced portfolio style ETFs. Some of them are 60-40 or 80-20 stocks and bonds. And generally the riskier ones, the more aggressive ones, those with higher equity weights have sold well and investors have loved them. This one has 125% exposure to equities. It uses cash borrowing to achieve 1.25x lightly levered exposure. So it has leverage. Extreme caution is advised, but it's one of the few ways to get total equity exposure with a little bit of leverage. If you're young and you have a strong stomach and a high risk tolerance, this is something to consider alongside or instead of an ETF like XEQT or VEQT, which are the all equity multi-asset portfolio ETFs.
Got it. Okay, let's get to your last past pick from last year then. A CI money market ETF. We'll take a look at recommended at, which was $50.11, and now to $50.09. So not a big change there. Right. A small drop return and a 4% upside return. What's been happening with this
That's
ETF?
Right. So take a look at that total return. That 4% return is actually just the yield, and that's the yield on your cash. So if you have a checking account or a savings account, or you're trying to manage your cash, and you've been doing so over the past year, and you see something like 3.5 or 3.2, you think that's not bad, right? This is the kind of total return you can get from a money market ETF that's low in cost, structured well, and you can move it into your portfolio and trade it exactly as if it's a cash line in your portfolio. That's how we use it in our model portfolios, and there you can see it has this funny sawtooth price chart, but that 4% yield that you've been getting on average over the past year comes from Canadian overnight rates, in addition to other kind of active yield pickup management techniques that they're able to do inside this ETF.
Got it. Okay, so we do have to leave it there for the past picks. We're going to take a quick break, line up some more questions for Daniel Straus. We're back in a moment. Welcome back. We're talking ETFs today with Daniel Straus. Let's go to the phone line. Sam's on the line in Toronto. Hi, Sam.
Hello. Thanks for taking my call. My question is on the role of a bond fund as a fixed income sort of substitute in a portfolio. And in short, I guess I'm looking at if I can get 4 or 5% and handle a little fluctuation in my investments, why wouldn't I just go all equity versus like I sort of put some money into bond funds and I just see them, they go down like everything else. And I'm just wondering if I can handle the risk, why do bonds even have any part in my portfolio?
Okay, fair question. Let's
right.
People want to know why they're picking what they're picking and what gets them down the road.
You can only imagine, Sam, how often we got precisely this question for almost 15 years in a row between the end of the great financial crisis, 2008-09, and I want to say around 2022 when we started to get this fastest rate hiking cycle in history in the aftermath of the kind of post-COVID stimulus and then in runaway inflation almost that we had in the Western world. So for that 12 to 15-year period, interest rates were near zero. We lived in what was called a ZIRP, a zero interest rate policy world. Bonds had almost no return potential. Their rates were near zero, and they only had downside. If there was going to be rate hikes, then the NAVs of these bond funds was going to go down. So we spoke with many investors and advisors, very similar to Sam here, who said who ended up just using cash instead because cash had a slightly higher yield, and you could expect it to buffer some of the downside of your portfolio. The purpose of a bond alongside your equities is to zig when the rest of it zags. And if you have something with an appreciable amount of duration, something with fortress-like capital, U.S. Treasuries long term, ideally what should happen if there's a big market sell-off is that part of your portfolio should go up. And then the risk-adjusted return of your whole portfolio will be a little bit better. You'll have some ballast for the ride. So I would say that, why not go all equities? In fact, we meet many young investors who will do precisely that. If you have a very, very long time horizon and you can stomach those kind of roller coaster rides, that we've met a lot of people who've given up on bonds altogether. But if you're a retiree or you have some kind of risk aversion and you don't want to lose all your money in a big GFC-style market crash, then having a little ballast can help, especially if it would zig when the rest of the market zags.
Okay, so it comes down to two things: your timeline, which it normally comes down to, and your stomach for
precisely,
watching it.
Yeah. So you need to know yourself a little bit. You need to self-interrogate. Oh, yeah.
Got it. Okay, let's get back to the phone lines. Frank's on the line from Waterloo, Ontario. Hi, Frank.
Well, hello there. A very informative show and very well moderated. I'd like to get the guest's opinion on the Evolve product, Bank, B-A-N-K, based on the Bank of, with his opinion on the Bank of Canada's message today about no short-term risk, but maybe long-term risk to lenders. How would a lender or a bank, this ETF, be affected as opposed to the underlying stock? Could you please give me your opinion on that? Thank you.
Okay,
Yeah.
interesting
Yeah,
question.
no, thank you. It is a really interesting question. This is a very interesting ETF. The ticker symbol is very memorable and very simple. So kudos to Evolve. Their ticker game is really on point there. They managed to get the four-letter bank. But it's not so simple because this ETF holds banks and life cos. So it's a little bit of a broader basket than, let's say, you might find in ZEB, which is the BMO Equal Weight Bank ETF that holds the big 6 banks. Full disclosure, National Bank, where I work, is one of those. But this one also holds life cos, and it has what we were talking about earlier, which is this very light leverage, is 1.25x. It's not the same thing as you would see in the kind of Beta Pro or Pro Shares or Direction style of leverage, which is 100, 200, and it's now going to be 300% leverage every single day. Those are extremely risky and require daily monitoring. 1.25 leverage we call light leverage, still leverage. It will amplify the downside as well as the upside, but it does give you a bit of a long-term chance of like outperforming a little bit, especially if in the very long term if markets go up. So I would say bank, if you want to play kind of a macro call on, let's say, rising rates, which are something of the bread and butter of the financial market sector. In fact, I believe our strategists are calling for rates to go the other way. If there's a recession, this ETF will participate. Keep in mind that it is a bit riskier because of that leverage.
He was also asking basically on the Bank of Canada, saying a longer-term problem as opposed to a shorter-term problem with credit. The banks have been preparing for this, yes?
That's right. Yeah. No, they have. There's the banks in Canada in particular are extremely conservatively managed with a lot of balance sheet and capital to protect themselves. So if you wanted to invest in financials, and you felt like you want some European financials or American financials, there are ETFs for that too. They tend to be quite a bit more volatile, so it could be a safe place to kind of wait out a recession, but you would have to stomach some of that short-term drawdown.
Got it. Okay, let's get back to the phone lines. Richard's on the line from Montreal today. Hi, Richard.
Hey, good morning, everyone. Mr. Straus, speaking of bank ETFs, I'm asking you about EBNK. It's an Evolve product, European banks. I'm a senior, and I just wanted to know your opinion on, if you think it's very risky, what would you say the risk factor is? It is covered call, 33%. But I was also wondering, do you know any other ETFs that contain a non-covered call of European banks?
Sure.
Thank you.
Thanks for the question. Okay, so Evolve European Banks, enhanced.
Yeah. So very interesting. Again, this is very similar to the one we were talking about before. I believe because it's enhanced, that means that there will be some kind of derivative component to either increase returns of the yield. So kudos for noticing a little bit of additional risk there. But we've spoken with clients who were looking to European banks as a way to sidestep the Canada-U.S. component of the trade war. Of course, after Liberation Day announcements, in early April, it looks like the U.S. was going to war with everyone, everywhere, all at once. Right? And then there was a pause. So, a lot of kind of whipsawing happening in the markets there. So if you wanted to kind of wait out what was happening between the Canada-U.S. border, then European banks could be a good way to do that. There was a lot of interest in this asset class, this category, particularly coming out of the debt zone crisis. And there was new kind of monetary policy in Europe a number of years ago. That's why a whole bunch of these products launched, because people saw European banks as part of the story for European recovery from a number of years ago. So there are some active products. Hamilton is a Canadian ETF company that has kind of made its name by actively managing these baskets. So there is, I believe, a Hamilton Global or a European Bank ETF. The global one does have some European exposure. So it is a very good comparable. I would compare this Evolve one with the one from Hamilton. Look at their portfolio, see if you're kind of comfortable with the regional exposures, and go from there.
Got it. Okay, let's go to one more phone call. Sorry, no, we are going to take a quick break, but we'll be back with your phone calls in just a moment. Welcome back to Market Call. We have Daniel here. He is talking ETFs with us. We're going to the phone lines. Ben's on the line from Kingston, Ontario. Hi, Ben.
Hi, thank you for taking my call. Great show and great guests. Thank you.
That's nice.
My question is, of course, on the BTGD, and I don't know if they are opposing each other, when the Bitcoin goes up, the gold will go down? And what's your opinion on both the Bitcoins and gold going forward? Thank you.
Sure.
Thanks for
Interesting combination of Bitcoin and gold.
Yeah, really interesting. This is a very new ETF. It launched only in 2024. I mean, all the Bitcoin ETFs in the U.S. are very new. We've had them in Canada since 2021. But I would say that Bitcoin is uniquely volatile. I mean, it's had, if you look at its price chart, phenomenal return since it was just a, kind of a hobby project of a few cypherpunks. But now it's, there's BlackRock ETFs on them. There's dozens of them. There's, it has billions, if not $1 trillion in market caps, so-called, but it's got unique risks stemming from things like quantum cryptography. In our analysis, it basically acts like a very high-flying tech stock, perhaps not very, very recently, but certainly throughout its history when there was a lot of kind of growth and optimism and demand for new forms of like AI, technology, cloud computing. We saw Bitcoin showing very high correlations to those kinds of things, even though it's not a share in a stock and it doesn't produce anything, right? Gold is similar. It just sits there. And this ETF uses leverage to take $1 of your exposure and give you both Bitcoin and gold. Now, this is part of a new generation of products that are kind of combining all sorts of leverage and kind of back office tricks to, I don't want to say tricks, back office kind of very complicated techniques to give you multiple forms of exposure. And it's very sophisticated, very risky. And I would say that there are ways to kind of gain exposure safely to gold directly by holding the bullion through an ETF like GLD or IAU. These are US-listed gold ETFs in Canada that we might talk about a few. There's Vault from CI. So you can get gold very, very safely through an ETF. Combining it with Bitcoin, I think there's a thesis out there that says that, if the US currency is going to collapse and they debase their currency and so on, then this is kind of what you want. It's almost a bet against American corporate hegemony. I don't know why there'd be an ETF listed on the New York Stock Exchange that kind of plays into that thesis. So it's a bit of a head scratcher. It's kind of a funny narrative, but if you subscribe to that narrative and you want a flyer for that kind of outcome, there's an ETF for that.
Got it. All right, let's go to Fred calling from Burlington, Ontario. Hi, Fred.
Hi. Thank you for taking my call. My question is on HPYT, and of course it covers these, from what I understand, the U.S. bonds. And where do the up and down of the tariffs fit in here? That's my question.
Thanks for your question.
Yeah, excellent
Harvest
question.
Premium?
Yeah, definitely. Thank you. So this is, again, part of this new generation of products that are using things like call options to generate extra yield, not only on equities, but on even fixed income products. Even BlackRock has entered this game. They've launched a covered call kind of treasury-like ETF in the U.S. So this one has attracted a lot of attention because it's not an equity-style portfolio. It's fixed income, and then it will do all sorts of things to achieve additional yield. So, if you want a fixed income exposure and you really have yield targets, it's one of the tools in the toolkit. But to answer the question about how do the tariffs play into the bonds, to the bond market, we saw some very worrying signs a couple of weeks ago that the kind of correlation or connection between a fixed income portion of your portfolio and U.S. recession risk may be breaking down a little bit. Ideally, if there was a recession on the horizon, market traders and fixed bond market participants would be forecasting rate cuts. They'd start buying up bonds. You would see the bond market go up. There would be a flight to capital, demand for U.S. treasuries, at the same time as the stock market going down. The problem was, by small degrees, a couple of weeks ago, we saw both of them going down because the U.S. was, again, as we were talking about, kind of waging a trade war with the entire world. The entire world, it's very sensible, may have been spite-selling U.S. treasuries bonds, trying to get out of dollar positions, as the whole world has been renegotiating trade relationships around the U.S., which has been very erratic, to say the least, right? So what ended up happening was a bit of a worrying drawdown in the bond market. It means that particularly U.S. bonds, U.S. treasuries may not have the kind of ballast-like cushioning effects that you would want them to have in a tariff trade war. Doesn't mean if there's other kinds of recessionary fears or flames that it won't protect you from those, but a trade war, I would say that short-term instruments would probably be better.
Got it. Okay, let's go back to the phone lines. Ghulam's on the line from Toronto. Hi, Ghulam.
Hi, good afternoon. I currently am holding 3 ETFs, 2 in technology, which is ZQQ and SOXX, and the other one is on the safe side, ZUE. It's an S&P 500. I've got a GIC that's coming up for, it's already come up for renewal, and I don't think I want to renew that. I was thinking of splitting my GIC proceeds into these 3 ETFs, add to that position, in fact. You think that's a good strategy? And if so, which of the 3 would you recommend? Or which 2 of the 3 would you recommend?
Okay. Thanks for the question, Ghulam.
Yeah, Ghulam, excellent question. And you're absolutely right. Those 3 ETFs, I would say, are on different notches on the dial of the kind of risk and growth exposure that you can expect from U.S. equities. Now, I would say that the S&P 500 is probably the most solid, the safest, even though it has enormous exposure to the mega cap technology companies like Apple and Microsoft and so on. So if you needed to downscale your risk even more so, there are ETFs from that. For instance, RSP, that would be an equal weight S&P 500 ETFs. And there's EQL from Invesco in Canada. That kind of shifts the balance of the weighting away from those mega cap growth technology companies. ZQQ has been an excellent vehicle for achieving exposure to the NASDAQ with a currency hedge, the NASDAQ 100, the top biggest 100 companies on the NASDAQ stock exchange. It's not all technology, not all growth, but it is very much a lot of technology. Very much weighted that way. It just happens to be how the NASDAQ is culturally. So it's even more tech and growth in that one. Huge demand for that through 2023 and 24, but as we've seen, very exposed to downside volatility during a trade war environment. And then finally, there's SOXX. I believe the caller mentioned something that's purely semiconductors. We've seen this ETF achieve enormous ups and downs as the headline risk around AI and demand and data center processing and chip demand in manufacturing and mass data center construction. So SOXX is at the center of all those headlines, particularly around like the generative AI boom. Okay. It's one of the great ways to play that. So that's even riskier. So as I was saying, the ladder of risk would go S&P 500, then NASDAQ, then semiconductors, right? Yeah, so I would say that...
it depends on where
that's right. Fan your money out according to how you feel the risk flows. Yeah.
Got it. Okay. That's all the time we have today for your phone calls and your questions, but stick around. We have new picks from Daniel when we come back. Welcome back. Thanks again for joining us. We're going to go through new picks from Daniel today. His first on the list is Vanguard FTSE developed ex-North America high dividend ETF. What do you like about Vanguard? We did talk a little bit about them earlier.
That's right. So the ticker here is VIDY. It tracks a FTSE developed ex-North America high dividend index. And what we like about it is it kind of answers the question that a lot of clients have been coming to us with, which is, I want to get out of North America a little bit, or at least diversify a little bit. We meet a lot of people who have quite a bit of home bias, a lot of U.S. holdings, a lot of Canadian holdings, and very rightfully they want to put a little bit of developed international equities in their portfolio. But they want a dividend screen. They want something that will mitigate some of that risk. And dividends do tend to down risk a little bit a portfolio. So VIDY, it's very cheap. It has a very simple kind of dividend methodology. There are others out there that have kind of more of a quant element to them, but this one has a high allocation to European financials, which we were talking about earlier, less so to growth. So as a result, it's been able to kind of weather the storm a little bit when there was a bit of a growth sell-off a number of weeks ago. Even though it has dividend in the name, its dividend yield isn't super high, so don't expect any enormous income gains from this kind of portfolio, but it's a good way to diversify. And that's
more of a stabilizer, would you say?
I would say, especially if you have already a lot of Canada and U.S. portions of your portfolio.
Got it. Okay, let's move to your next top pick, Global X Equal Weight Canadian Groceries and Staples Index ETF. I've heard some people argue that this is the way to go, especially if there's a recession or a downturn.
That's right, yeah. So I should point out that we like to call these not so much picks as research highlights. We're research analysts, not portfolio managers. We do a lot of research on ETFs. And this ETF kind of bubbled to the top of the screen when we were doing research on the sectors of Canada and which ones have more or less exposure to U.S. revenue sources, export and so on. And we have a whole report on that. It's called ETF Strategies and Tactics for a Trade War. And what we found was that especially Canadian staples are already a bit recession-proof. And this ETF is from the Global X Best of Canada series. They've waived the fee to the end of the year as kind of like a venture to kind of attract attention to this ETF, particularly because they're Canadian companies. There's only 5 holdings in them. And especially for the next year, you won't be paying an expense ratio to put all 5 in a single basket here. And, the grocers, the staples, they've been controversial in the past, especially in our inflationary environment, but it is a good way to get particular kind of like a recession-proof industry that's Canada-focused. So for those ETF investors who want to buy Canada, this is kind of one of the ways to do that.
Is that because they have other places to pivot in Canada if they do rely on American import?
It means that they mostly serve the Canadian market. It's kind of self-contained. It's one of the narratives of self-sufficiency here in a big way.
Got it. Okay, let's get to your next research pick then, which is CI Gold Bullion Fund, currency hedged on the TSX. Tell me about this one.
Yeah, so we talked to a lot of investors who are looking for alternatives, an element of their portfolio in the single-digit percentages, sometimes as high as 10%, which can act as a bit of a diversifier, something that will move differently from stocks and bonds. And there's hedge fund replication ETFs now. There's kind of infrastructure and even private assets. They're all making their way into ETFs. There's very complicated products out there, but this is one of the simplest and longest-standing way to do that. It's gold. I would not necessarily expect in the coming period for the gold performance to behave as it's done in the past few weeks. It's been doing quite well because the global markets are quite worried about what's happening with this trade war going on, and gold is behaving exactly as it should in an environment like this. VALT, this particular one from CI, it's currency hedged. So in the past few weeks, when the U.S. dollar fell very suddenly, the Canadian dollar jumped up by 5%, erasing some of the losses that it had made as all these tariff news was percolating. You'll see that it outperformed Vault.B or /B, depending on your system, which was the unhedged version. It's one of the cheaper gold bullion ETFs. It holds gold in London. Very, very efficient way to get gold bullion. There's all sorts of other ways. So if you hold Kilo or CGL, no need to necessarily switch. They all do the same thing.
Okay, and you mentioned that it's a little bit cheaper. How much cheaper would it be?
That's right. So its expense ratio is something like 17 to 20 basis points. It depends. So that's quite low. There are gold ETFs out there that charge as much as 55 and so on. So those kinds of expenses can compound over time.
And you said you'd wait a little bit to get into it just because of where gold is now?
I would say I would wait a little bit, and then I would say use a small amount and just kind of keep it there and rebalance at very small levels so that you can have that piece of your portfolio act as a diversifier.
Got it. All right. Daniel, thanks very much for coming in. Appreciate your time and your expertise on the show.
Thank you. Pleasure to be here.
We're going to leave it here for Market Call. Thanks very much again for joining us. We'll take a look at the markets as we go. We'll see you again tomorrow.